Let's talk about how these deals that Trump has reached, or framework deals that Trump has reached with Japan in the EU, could affect Canada. We're joined by Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Great to see you.
Oh, thanks for having me on.
So I guess one problem for us, a 15% tariff for the EU on exports into America is bad, but it could be even worse for us in that we're so dependent on the US.
Exactly. Well, to a degree. So I think I guess if you look at that framework and what's happened is you've seen kind of that baseline, right? You've seen the UK, which is on very friendly terms with the US, probably as close as an ally can get. They're at 10%, right? And then you've seen countries as far out as 20%. And then the EU is kind of in the middle at 15. So, I think with Canada, it's, you're going to fall within that range, hopefully within the lower end of that range, probably towards the UK, hopefully. And what it's become now is it's, I guess, forget the concept of free trade any longer, and now it's no longer about absolutes. It's about relative basis. Who gets a better trading relationship with the US? Mm-hmm. So, if we get tariffed at, say, 15% and China gets tariffed at 20%, well, we have a tactical advantage now, right? And so it now all just becomes a relative functionality on how tariffs work. So I think the guardrails are there. I think not guardrails, but I guess the goalposts have been set. Mm-hmm. Right? You want to do business with the US, it's something between 10 and 20%. And, depending on how valuable you are as a trading partner to them, I guess, you're going to be at the lower end, the higher end of that range.
Apparently these deals, though, they're just memos of understanding. There's been no official text announced because, of course, they're so complex, any kind of trade negotiation.
Of course.
Yeah.
Of course. But I think people should come to the rationalization of that's what they want, right? As a country, they've decided that's what they want. Unless there's an election and everything changes, for the next 4 years, that's the framework we're going to live by, right? And so I think people need to come to that realization. And the other one they need to think about is, just because you get tariff doesn't mean you're in a bad position. Like I said, it's a relative function, right? So I'll give you a worst case scenario. Let's say, who's Canada's primary competitors, right? Because we are a resource-driven economy. Well, we've got Brazil, Australia, Russia. That'd be our big three competitors in terms of what we provide, and what they provide is very similar. And so now it's just relativity, right? Like, if we're taxed at 10 and Brazil's at 50, great. We're doing fantastic, right? If we're at 10 and Brazil's at 5, not so great. And same goes for China, same goes for a lot of other countries. And so, part of the reason the stock market has rallied so much is there is the anticipation that because of Canada's long history with the US, because there's, that huge shared border, there's no real point to overly tariff us, right? That we would come in at the lower end of the range. And on a relative basis, most of our companies are going to do relatively well, right? Mm-hmm. Now, there's obviously volatility attached to that in that what happens if you don't? What happens if they come out and say, no, actually Canada gets 30, the rest of the world gets 20, then, we're going to be on an offside position. And that's why we always say, always get back to first principles. Nothing is going to be diversification for you on your portfolio, right? At the end of the day, diversify, and diversify again. And make sure you have your three core asset classes, which is equities, fixed income, and alternative investments. And make sure you're sheltered that way, because at the end of the day, the next few years is going to be probably a little bit more volatile than we're used to. And I think we should have a defensive portfolio built for that.
When you say alternative assets, what kinds of things do you mean?
And so that's, again, a broad base. That could be private debt. That could be private equity, that could be venture capital, that could be real estate, right? So there's a broad base there, infrastructure. And so those are all things that, we always say is, it's becoming more of a necessity in your portfolio these days, right? You're no longer truly diversified when you're just fixed income and equities, because the problem is those correlation benefits have broken down. So since 2022, it's something like 80% of the time, if the stock market's down, the bond market's down, which wasn't always the case, right? But it's just the last few years, that's just the way it's been. And so, you're no longer truly diversified if you just have fixed income and equities, because most of the time they move in the same direction. And so alternatives, that's your volatility dampener, if you will, right? Because it moves in sort of a different direction, right?
What about gold? Are you in the camp that says an investor should always have a chunk of gold in there?
I am not in that particular camp, but I would put that kind of in the alternative bucket. I mean, the end of the day, that also is an uncorrelated asset class. It tends to move more in tandem with the US dollar than anything else. But, I mean, it's not going to hurt you to have a small allocation to gold in your portfolio.
What about crypto? I guess that depends on the investor, how comfortable they are.
Exactly. I mean, that is a highly volatile asset class. And again, you have to be comfortable with that asset class, right? I mean, crypto is the 100 or 0 kind of thing, right? You're either going to double your money, it's going to go to 0, and you can't be sad either way, right? And so that's a different kind of asset class when we talk about risk. I mean, you're flipping a coin, effectively.
And certainly with the, you hear so much about crypto fraud and people's money just vanishing.
Right.
Certainly buying a crypto ETF sounds like a safer way to do it, in that it's going to be volatile, but at least you can buy and sell it.
Well, I mean, I don't know, because if the underlying asset is crypto, you have the same underlying problems, right? It doesn't suddenly go away. You know what I mean?
I just mean your money doesn't vanish from some crypto exchange or something.
Yeah. It probably helps in that way, sure. But when we talk about alternatives, we're not really including stuff like crypto.
Right.
We're talking about more normal asset classes like real estate, private credit. That's just basically a nice way of saying loans to other companies, right? Private equity is basically the same thing as public equity, except you own a private company, right? There's still normal asset classes, Digital assets, that's a whole different realm, something we don't really play in. But, look, I mean, depending on who the investor is and their risk tolerance, I mean, it's not going to hurt them to look at it either, right?
We speaking of private investing, we just see this relentless removal of stocks from the TSX. You probably saw First National Financial is going to be taken out.
Yeah. No, I mean, look, that's an ongoing thesis. Part of that has been really that ETF evolution, right? And so the problem with the ETFs is that it tends to be very large cap focused.
Yeah.
Right. And so, if you're kind of a smaller company that's listed on an exchange but not part of an index, it's very hard for you to get volatility. It's very hard for you to get liquidity these days, right? Without that ETF support. And so what you see is a lot of the companies that are not part of an ETF are going private. And they'll probably grow in the private world and then come back and go public again once they're larger and more sort of index or ETF worthy, right?
I hadn't heard that before, that the ETFs are contributing to the lack of public companies. I mean, Jamie Dimon has talked about it south of the border as well.
Right. I mean, but that's the problem, right? I mean, how do you take Royal Bank at 200 billion market cap and then put in a 200 million market cap company in that same index?
Yeah.
It makes no functional sense, right? And so I think that's the core driver of it.
We better leave it there, Jay. Thanks very much, as ever. Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Coming up, we're going to hear from Canada's